So glad y'all are here today. Welcome to our 2024 forecast event. You know, it's hard to believe this. Earlier this week, I was talking to Herb, and this is our 34th forecast. I think I was 26 years old when that started, but that's another story. Anyway, we're so glad you're here this morning. We have a great lineup. Bob Young, our Executive Managing Director, is going to deliver the results for 2023. Additionally, Herb Weitzman, our Executive Chairman, and Anton Pil with J.P. Morgan, who in my mind is one of the premier financial minds in the country, is going to have a discussion about what they see for 2024. But before we do that, I first want to thank all of our customers for allowing us to handle your real estate needs this past year in 2024. Additionally, I want to thank our leadership team and all of our associates who have worked really, really hard this past year and this year to help us get these results. And now it's my honor to introduce Bob Young, who's going to present the survey.
Thank you, Marshall. And again, as he said, thanks to everyone for being here early this morning. It's my honor to share the results, as he said, of our 34th shopping center survey in this massive DFW retail real estate market. Since starting in the business in 1980 in the office building side, but 22 years I've had the great fortune and education to be with Herb Weitzman in the retail space, I've seen a lot of things. But in 2023, I, along with many of us, saw something we've never seen from the first time. But in 2023, DFW's retail market reached and it surpassed the highest occupancy rate ever. We're starting 2024 at 95.2%. Before the milestone, the previous year for a record was 42 years ago in 1981, when the occupancy reached 94.8%. Since that previous peak, think about what we've been through. We've powered through a real estate crash, the rise and fall of the mall market, the failure of numerous retail chains, several recessions, the prevalence of e-commerce, and yes, Amazon, and how could we forget a global pandemic? And at the low point in 1990, as a matter of perspective to what you're going to hear, nearly 20% of DFW's market was empty and vacant. But retail real estate, we learned our lessons from all these downturns, and we have emerged stronger than ever. Brick and mortar retail is proving to be more essential as the industry has the ability to transform with tech and mortar. Tech and mortar is what we call supercharging the physical retail real estate with the digital outreach. Tech and mortar fulfills consumers' preference for convenience, selection, and experience. ICSC calls this the halo effect, whereby that the brick and mortar stores create not only a place to shop, but it enhances brand awareness and consumer trust. Thus, the store itself plays a critical part in driving both sales in the store and online. And remember, in retail, it's all about the sales. So let's look at some of the points to consider regarding this record-setting occupancy of 95.2%. It represents vacant space of 9.6 million square feet, a drop from 11.2 in 22. And as recently in 2020, our market posted 17 million square feet of vacancy. So that's more than 7 million square feet of net occupancy in just 3 years. Now, as many of you know, Weitzman, here in our DFW office, we survey in person more than 1,400 shopping centers, 25,000 square feet and greater, not 24,999 and below. If you want to understand retail real estate, you need to experience retail real estate on the street. So our comprehensive research analysis revealed strong occupancy throughout the entire Metroplex. Occupancy in the Dallas area was 95% compared to 93.8% in 2022. The rate is based on 1,001 projects with a total market inventory of 137,000 square feet. The occupancy rate in Fort Worth area was 95.5% compared to 95.6% in 2022, and that rate is based on 429 shopping centers totaling 62.3 million square feet. Now, Weitzman operates in all the major markets in Texas, and we are seeing similar statistics. It reflects a healthy market. Austin, for example, is 96.8% occupied. Houston is 95.4%, and San Antonio is 95%. Retail in these four metros now services 70% of the state's 30.5 million residents. And the four economic powerhouses together make up one of the most powerful statewide retail markets in the country. Now let's break down the positive impact on net leasing by each major shopping center category that we track in 2023. And in that regard, all of the major categories we survey reported above 90% occupancy. So first, for community centers, that's the grocery-anchored category. Occupancy climbed to 96.2%. That's the strongest occupancy ever. Grocery-anchored retail dominates the market inventory with 488 properties totaling 74.1 million square feet. Community centers continue to benefit from the daily traffic of their grocery store anchors, as well as shop tenant mixes curated that focus now on quick serve and casual restaurants, a line of services, fitness, health, and beauty. Community was also the most active construction in the category of construction, accounting for almost a quarter of all new retail space in 2023. This trend will continue in the new year with new stores from leading grocers like Kroger, Tom Thumb, and H-E-B. Now let's look at neighborhood centers. They are the smaller, unanchored projects. The neighborhood category in an inventory of 40.4 million square feet is in 677 centers. It reported also its highest occupancy in the Weitzman survey history at 94.4%. Now, what's noteworthy is that 10 years ago, this was the market's weakest category when overbuilding and weak demand, it was like 16% vacant. But today, neighborhood, this category has pivoted, focusing on patios and open dining experiences and drive-thrus, dining, services, and again, boutique fitness, health, beauty, and medical. The next category is malls. Malls, unfortunately, at least nationally in some situations, have been the poster child for retail struggles. But here in DFW, years of demolition and redevelopment of weaker malls had removed more than 15 million square feet of that inventory. The remaining malls are primarily strong performers. Malls have found success in evolving with a focus on experience and entertainment. Most malls, the current report, they're at 91.4% with 18 properties totaling 21 million square feet. And that's an improvement over last year at 90.7%. Mall leasing increased with new inline tenancies for apparel, sporting goods, and again, the restaurant category. Now, notwithstanding, the category still posts higher than vacancy than other markets due to the large format vacancies that were left in the previous years by the closings of Sears and Macy's. Now let's look at mixed use. Mixed use with an inventory in DFW of 11.3 million square feet of retail space recorded strong occupancy at 96%. This category benefits from density. The mixed-use retail located in these projects is with high density and multifamily, as well as office and other complementary uses. This category is clearly helped by the strength of the multifamily market here in our area, which reports high occupancy. Now let's talk about power centers. Power centers with an inventory of 44 million square feet in 150 centers reported occupancy at 95.7%. That's up a full percentage point from the previous year. This improvement still occurred in the face of the failure in 2023 of Bed Bath & Beyond and Tuesday Morning. These two bankruptcies alone created 600,000 square feet of new vacant inventory in DFW. But many of these spaces didn't remain for long, illustrating just how strong our market really is. And by way of example, retailers like Burlington saw the opportunities of these vacancies as the ability to expand in a very tight market. Now let's talk about net leasing. Absorption in 2023 remained strongly positive at a healthy 1.8 million square foot number. Overall, the market's large vacancies were leased by quality retailers and concepts like Sprouts, Barnes & Noble, Nordstrom Rack, Ross, Burlington, and Joe V's Smart Shop from H-E-B. Fitness concepts were also especially active, backfilling locations including EOS Fitness, Fitness Connection, Planet Fitness, Crunch, and Club 4 Fitness. And again, if you've got a well-located box in today's market, you won't have it for long. Now let's talk in more detail about construction. New space deliveries during 2023 created just over 1 million square feet. That's compared to 2022's record low of 539,000 feet. The majority of the new space in 2023 was from users like H-E-B and Target, with very limited peripheral spec space. This is extremely low construction for a very tight market with healthy demand in one of the strongest economies in the country. So why aren't we seeing construction totals higher? One factor is phased construction. Even the largest project in our Metroplex, like Gates of Prosper or Grandscape, they deliver space over several survey periods. And another cost is the cost of construction. Higher costs mean higher rent levels to economically justify new development. So whatever new space does come on the market today, it commands some of the market's highest rents, both for inline and junior anchor positions. The limited availability of well-located vacancies still allows active anchors to expand in existing space. But the tight market for space means we could see more anchor demand push new construction and/or infill redevelopments, pardon me. So what did get built in 2023? Leading the pack were two new H-E-Bs, one in McKinney and one in Allen. Together, they accounted for nearly 22% of all new space delivered. In terms of anchors, that's about it. However, this year will be very different. For 2024, we will see new stores in the works for the following lineup: H-E-B, Kroger Marketplace, Tom Thumb, Joe V's Smart Shop, Sprouts, Costco, Target, and Lowe's. This year will be the most active new construction market for grocers in a decade. Highlighting this point, in 2024, at least 14 new grocers will either open or be underway. The previous year for similar strong grocer activity was 2014, when 9 new groceries came online. But even with this ramp up in anchor activity, new construction will likely not top 2 million square feet. In closing, as you could see, our retail market is looking pretty good. I mean, so good, in fact, it's the best we've ever seen. And at the start of 2024, with me here representing our firm, we have a lot of reasons to think it's going to be even better in the upcoming year. Oh, we will face challenges, for sure, but we've always worked together to overcome them. Retail real estate is more than brick and mortar. It's ideas, creativity, and community. And it's supported by all of us in this room and by our entire shopping center industry, striving to be the best. That said, the Weitzman forecast for 2024, first, occupancy. We expect the market to remain stable and end the year at 95.8% leased. Second, absorption. We forecast healthy net leasing of slightly more than 2 million square feet in 2024. And third, construction. We fully expect construction to increase to nearly 2 million square feet based on what's in the pipeline. So as you can see, building on the 23 DFW retail market being the best ever, and our forecast for 2024 for occupancy, absorption, and construction, that'll make for another record-setting year in DFW. And again, it's been my honor on behalf of our company to present this Weitzman 24-24 forecast, and we look forward to working with every one of you. And clearly, this is parochial, my friends from out of Texas, clearly we are all fortunate to be in Texas, the greatest retail real estate market in the country. Thank you. Now I'm excited, and it's my pleasure to introduce our special one-on-one conversation with our founder and Executive Chairman Herb Weitzman and Anton Pil, Managing Director and Global Head of Alternative Investments at J.P. Morgan Chase. Help me welcome Anton and Herb to the stage.
Wow, that was pretty spectacular. Huh?
Well, thank you. Yeah, we got a few things going on here in Texas.
Yeah, it's so
Anton,
exciting to
so
be
great.
here with a legend and then see these results all at the same time.
Well, we've been playing in this ball game a long time, and we've seen this market grow from, we were about 700,000 in Dallas when I got into business, and it's pretty amazing. We're at 8 million now, and I think the best is yet to come.
Totally.
But the interesting thing is that all this is happening in other markets as well, Austin, San Antonio, and Houston. And so, audience, it is my great pleasure to have an opportunity to visit with Anton. I met Anton, I went up to New York, and he was so hospitable. We were going to meet, shake hands, spend about 15 minutes. And after about the third time, his assistant came in and says, Anton, you've got to come back to this merger negotiation that's going on. And so he spent about 45 minutes with me. We built a relationship, and it's wonderful. I want to thank Chase. We've had a wonderful relationship with Chase for 33 years. And I want to thank Elaine particularly. Elaine, I know you're the chairman of Texas, and I know you really twisted Anton's arm, but I didn't want you to break it. He's got this sling. He walked in with this sling. And, Chase has a little influence with Southwest Airlines because they made sure that plane was leaving Austin this morning to get Anton here in time.
Oh, you would look.
Yes, sir. Yes, sir. So Anton is over with this group, all alternatives for J.P. Morgan. It totals $213 billion, and this group has about 700 people in it. And I want, Anton, I want you to talk to us just a minute about all the alternatives that you're into, and then how they connect with real estate, because real estate is $54 billion. It's the largest group.
It is the largest group.
Right. So
Yeah, it's a. So I've been with J.P. Morgan, and I've worked with Elaine for ever since I got out of college, so for almost 30 years now, and run what are called the alternative investments at J.P. Morgan on behalf of clients. So maybe walk sort of at a very high level, things like private equity. So we own a school bus company. We own life sciences drug companies directly as a private owner on behalf of our clients on private equity. We're a lender of last resort or private credit for, so pretty much anything that's not stocks and bonds is kind of what my team does. So we're a lender in private credit for special situations around the world. We have a very large hedge fund business, which most of you are roughly familiar with what hedge funds do. We have a real assets business, so we own El Paso Electric, for those of you from El Paso, which is like, think infrastructure, shipping. We're the world's third largest LNG ship owner. We're a forestry owner in our real assets business. And then lastly, we're in the real estate business. And the real estate business, as you pointed out, is 54 billion. Most of it's in the United States, but we do have exposure both in Asia and Europe as well. And it's a phenomenally fascinating job because I get to watch, we harvest wood in Arkansas, we put it into pellets and ship it to Europe. We heat Europeans with it and, talk about carbon and whatever you want. Like, chances are we're somehow touching it. And I think it's been a fascinating journey. And by the way, full circle back to Texas, we actually are a pretty sizable real estate owner here in Texas, including a real estate. One of the largest malls here in Dallas we own. We own one of the largest open-air malls in Houston, 13 grocery-anchored stores as well, and 10,000 plus apartments. So, and by the way, have a remarkably similar view as Bob. Everywhere we go, and by the way, the funny thing is, I was in Texas 3 weeks ago going to Big Bend National Park, and it's just an amazing place. And there's growth everywhere, right? Like, you go to like Del Rio, and like, I couldn't find propane. They're like, it's all sold out. I was like, how could it be sold out? It's the growth is phenomenal, and but I will tell you the secret thing that nobody knows is retail is doing tremendously well across the entire country. Probably doubly as well in Texas. But it's like, I wish this whole presentation could be given to the rest of the country. Because if you go out to the rest of the country, they're like, oh, retail. It's not, we don't do retail. As from an investor standpoint, and I think it's actually entirely misguided. I think everything you guys have shown here, I think is fascinatingly interesting, and it's exactly what we're experiencing on the ground. Long-winded way of explaining what alt is.
Well, what industries are you in that have a connectivity to real estate, like timber, for example? Now, we've seen costs, be so high and rates were so high that, we had to go and do research and find out alternative ways to cut prices. And the timber has been, the opportunity, I think, to, do that. And I've seen buildings underway just this last week under construction with timber. So did you go into that intentionally to connect to your real estate portfolio? Or give us a little information.
Yeah, so we got into the timber business about 3 years ago. We now own $10 billion of forests, predominantly in the United States, but also in Australia and New Zealand. And you nailed it. Actually, there were two big reasons I wanted to make sure we owned, well, actually probably three. The first was, trees don't care about the Fed. It's like they're gonna grow. They'll grow 8 to 10%. Like, if you have a really good tree, it'll grow at 12. Like, if they're in the Northeast, you don't want to own them because they'll grow at 6. Like, and the beauty is, it doesn't matter what's happening around the world. Those trees keep growing. And so, from an assets perspective, if you want diversification, it's the ultimate diversifier, because we also ultimately know that for all that construction, you need land. And eventually, whatever forests you own, eventually a town or a city will start impinging on it, and you'll start be able to sell some of that land as well. So, so that was sort of issue number one. I was a little worried about inflation, and the land value really appreciates with inflation, and I thought that that would be valuable. But the second was what we were doing in our portfolios on the construction side inside real estate. Building codes have changed in a number of states that now allow you to build buildings out of wood up to as high as 16 and 20 stories high. Now, we don't have retail that high, but we do have multifamilies across the country, apartment buildings that are becoming that high. And I'll give you an example. Where I live outside of New York, there were two, by the way, I don't know why they're building more multifamilies there, but that's a different story. And there's two buildings went up simultaneously a year and a half ago. One was made entirely out of wood. By the way, they're both 14 stories. They're right next to each other, which is fascinating. And one was made out of steel. The one out of wood was built about 2/3 faster than the one out of steel. And it's a lot, the wood isn't necessarily cheaper, but a carpenter is a lot cheaper than a steel worker. And so for us, this kind of change in building code that allows for higher construction out of wood, the speed of construction is faster, the labor is cheaper, and that for those of you who are in the construction business, you know that those are sort of the key ingredients for your costs. And so we anticipate that wood construction is going to continue to grow tremendously across the country. I've had some naysayers. I'm like, well, I don't want to live in a wood building. Really? Like, think of if any of you have lived in an apartment, when's the last time you knocked on the wall and we're like, well, is this wood? Because if this is wood, I'm not living in this building. Like, it just doesn't happen. And in Europe, of course, we're seeing the classic European, carbon is bad, so we don't want cement. And we don't want steel because they're very carbon-intensive industries. But wood is not. Wood captures carbon. So we're also selling a lot more wood for construction from the United States and shipping it over to Europe for construction where they have a carbon tax. So 100%, I think it was, and then there's this carbon option. Like in the back of my mind, I'm always trying to think 10, 20 years out. Oh, look, if the Europeans want to start taxing carbon, the only thing that is negative carbon is a forest. That is really economic. And so, like, maybe one day we won't cut the trees, and like it'll just be a carbon sink. I don't think that's going to happen, but,
Well, after I visited, about 15, 20 minutes with Anton in New York, I said, this guy's a visionary. Now he just admits it. He's thinking 10 to 20 years out there.
It is JP Morgan. Things take a long time. I'd love to tell you we're a small, dynamic organization, but we try to think a little further ahead.
Well, at least you're ahead. Well, everybody here is involved in commercial real estate or involved in retail, or a lot of bankers, city officials, and everybody here is paying close attention to the economy. And we've dealt with inflation is really wreaking havoc, even as rates come down. A lot of foreclosures, postings this past week. And I'd like you to talk about your vision. I think everybody really, raise your hand if you're interested in the economy. Okay, so why don't you give us your opinion?
So look, from where we sit, we think 24 is actually going to be a pretty decent year. The inflation is coming down. We just saw the reading this morning. It's still at 3.5 and change. But the trajectory is clearly going towards that too. I think the 3% to 2% move to inflation will be the hardest for the Fed. And that probably means the Fed is going to stay at current rates for longer than most people think, but they are headed on the way down. I think one of the things I find fascinating is everybody's like, when are they going to move? When are they going to move? But they forget that it's the Fed. Like, if you think JP Morgan can be slow, like the Fed doesn't have to do anything. And I don't think they will. I think they're going to take their time. They're going to want to make sure that the inflation genie is really not totally out of the bottle. And that could take 6 or 12 months. The good news is that unemployment is still very low. Wage growth continues. This notion that the average American is over-leveraged again, I'm not really buying that. I became American 6 years ago, and I'm originally from Belgium, grew up in Brazil, and lived here long enough that eventually I was like, I need to become American. And I will tell you, the one thing Americans have figured out is you give them credit, they'll spend it. And like, it's not like, well, you know, they're overthinking. No, they're not. They're like, give them $10,000, they'll spend the $10,000. They're not going to save it. Like, just gave it to them. Why wouldn't you spend it? So, and so this notion that the consumer is somehow tapped out misses a very important point, which is about 2/3 of consumers' debt is their mortgage.
Isn't there mortgage?
Yeah. And their mortgage hasn't changed. It's a 30-year fixed rate mortgage. And by the way, we think that's the whole world is like this. That is extraordinarily unusual. It's really only in America where you can get a fixed rate mortgage, by the way, at 2.5%, 3.5%, 2%, hopefully not at 8% from last year. But so anybody that is a homeowner, their ability to tap their credit card is much greater than I think the history would have shown, because that corpus of the bulk of their debt has been fixed at such a low rate. The flip side is also true. If you're not a homeowner, though, you are going to suffer for some time. And that's where I think we are going to start seeing people tapped out. That's probably more on the lower end, on the middle income, lower middle income side. And I think that'll have an impact on spending later on in the year. So if I think of things like soft goods stores or stores that are targeting sort of lower middle income, I think that's where I think we're going to see a little bit tighter conditions. But I think the economy is going to end up doing reasonably well. It'll probably grow at 2 or 3%. The wild card is if inflation doesn't come down. And what could cause the inflation not to come down is still overheating the economy, where the inflation, especially if an inflation shock comes from outside of the US. I don't see that happening. But you know, if you look at inflation today, a year ago we were talking about eggs and like the importance of egg inflation and eggs and the chicken. I don't know what happened to the chickens. Apparently they weren't laying enough eggs, and so we had a lot of egg inflation. Food's all about eggs. Now the number one thing in inflation is all about insurance. They're like, oh my God, insurance is up 15%, and this is insurance. Don't get hung up on these subcomponents. There's always going to be something inside inflation that's going to be high. And I can tell you that, well, for example, one of the things that says is coming down is health costs. And having just done surgery last week, let me tell you, I don't know where they're taking their surgeries, but like health costs are not coming down. And so when you look at this, I think the risk we do run is that inflation stays a little bit higher than people want. And that simply means the Fed's going to be on hold. And so I do think Fed, by the end of the year, you'll probably see the Fed will probably end up around 4, 4.5 on the Fed funds. And I do think your 10-year rate will end up still around today's levels, 3.5, 4. Any fixed income manager that manages bonds will tell you it should be 3, 2.5. Of course, this is what they want you to believe, right? But I think realistically, we could very much look at a rate environment very similar to today by the end of the year. There are really good signs, though, for credit. Real estate credit has been really tight. And I'd say in the last 3 or 4 months of last year, we started loosening up. We lend about $15 billion in commercial lending from my team directly to developers and to building owners. And where we would have charged people SOFR or LIBOR, think floating rate plus 350 at the high, those numbers are down to about 2.25%. And I think that's going to keep coming down. So that's actually healthy. We need some movement in the real estate market to also prove these valuations, right? We can tell here that our experiences in retail have been great, but if there's not a lot of people buying and selling, no one's totally believes the numbers. And that's, I think, a little bit of the challenge on the real estate side, is that there just haven't been enough transactions to prove out what the real baseline prices should be. But sort of at the macro level, by the way, US is the place to invest. And by the way, so is Texas on top of that. Like, people say, buy Europe, just don't bother. Like, it's fine. Like, US is doing really well. I think it's going to end up being a decent year. From a market standpoint, I don't think the equity market's going to see a 25% repeat from last year, but I still think it's going to be a decent year. I think a lot of these earnings are very real. Most of the returns last year came from 7 stocks. By the way, those 7 stocks will do just fine this year too. Like, I think people are like, oh, they're going to come down. And I was like, no, they're not. Microsoft, Apple, Google, these companies are doing tremendously well. And the reason they're doing so well is they're the first users of AI, of the new version of AI. And that new version of AI, this large language models, is something totally different than what we've seen in the past. And that's going to trickle down into all the companies, every company. And that's going to be extraordinarily great for the US because first, the US is by far the furthest ahead in that versus the rest of the world. But it also means that there will be productivity improvements, which means that wage gains can continue to grow without adding inflationary pressure. And those 7 companies have adopted AI much faster than the next 493 in the S&P 500. And so that's something we all have to look forward to in the next couple of years, that as this trickles down into day-to-day work, it'll allow for more wage gains and less inflation and productivity, which, by the way, will result in more retail sales.
Sure. Well, there's 2 things that, I want to touch on here. One is we have one of the foremost researchers that produces all of the housing sales and lots that are created in the Metroplex, and he thinks that we're just cutting loose with a whole new boom. Okay, rates, there have been some reductions. There's stated 3 more reductions in 24.
Yep.
So that's going to be very positive for those houses being purchased. But what's a lot of people say, well, people can't afford a house anymore. That's why they got to go into an apartment. And what you're saying is really, that's not the case. The rates are going to come down. They're going to be able to buy a home. But most people early on in their career get married, they move into an apartment. They don't go into a house. So, it's a good process.
There was a bit of a delay, I think, in home ownership. And that, by the way, that's a global phenomenon. That's not just a US phenomenon. But a lot of that also has to do with the demographic shift that most people don't want to talk about. People are getting married much later. And so you used to get, if you think the average age people used to get married at, I think it was like 22, then it was 24. I think we're now up to 28, which means that the number of units you need for single people is just bigger than it was, even if you had the exact same population. So in places like Tokyo, we're still building single bedroom apartments because there they get married at the age of 34, by the way. So if you kind of do the math, if you look how many single people are living and doing that, that's pushing back, I think, home ownership because you don't have a dual household, sort of 2 household income to be able to afford that. I don't buy a lot of this stuff, though. I kind of remember, you probably remember this too, like a decade ago, or maybe that wasn't even that long ago, 7, 8 years ago, it was all about lofts. Everybody's going to live downtown. Nobody wants to own anything. It's all about sitting on an elephant in India. We don't need all cars because why would you need a car? And I looked at it and I was like, yeah, it's easy to say. It's because the Gen Zers, they have no money, so they can't buy anything. So of course you don't buy a car. You can't afford it. You can't buy a house, of course not. You don't have kids, so a loft downtown sounds great. The minute you get married and have a kid, the loft is probably the worst possible thing you could live in. And they're like, oh, well, now we need a car. And guess what? In 7 years' time, people are now in the suburbs. They're buying homes. And if you look, where are the best performing places? The community centers, the community retail centers. All those centers that people were like, no one will ever live out in the suburbs again. And the reality is, you can't get everything on Amazon. You can't. And you can't get experiences on Amazon. This whole notion that somehow e-commerce is going to take over a lot of that's happened. There were 1,500 malls in this country 5 years ago. There's 1,000 left. We have 17 of the top malls in this country. I can tell you there's a wait list to get into the malls if you're a retailer. You can't get in. We have pricing power. The contraction has taken place. The stigma is still there, but the contraction has taken place. And what we've heard from our retailers is that when they have a presence in a state, their online sales in that physical presence, their online sales in that physical state will be 10 to 15% higher. I think you're going to find that number to get even bigger. And the reason for that is when you go online, think of how many ads you get. You know how expensive it is to get somebody to come to your website? If I hang a Pil Inc., new shoes, well, first, no one to go there. But and I wanted to try to convince people to go, the cost of marketing online has gone up dramatically. And you know how you can tell that? Look at Google's earnings. It's not hard. Cost of marketing online has gone up. So what is cheaper? It's cheaper to have a retail presence brick and mortar that actually acts as sort of attracts you and sends people to their online store. To me, the writing was on the wall in a positive way for brick and mortar when Amazon decided to just build real stores. To me, that was, like, so if the largest retailer online decides to actually get into the brick and mortar business, probably tells you something. And I think that's it. It's getting very expensive.
And all the smaller guys that followed suit with that, they need that brick and mortar presence. And there's been just the convergence. And we collect rent on about 3,500 tenants. And so we see the volumes on a monthly basis, and we see the delinquencies on a monthly basis. Perfect.
Yeah.
Hardly any delinquencies, and the volumes over 19 are up, and it's because of the convergence that's taken place.
I think that's right. And also COVID, right? COVID shook out a lot of retailers that were on the edge. That just pushed you over the edge. If you were over levered, you weren't going to survive 2 years of very weak sales. You just weren't going to survive. So I think ultimately the survivors are in much better shape as well.
Yeah. Well, you know, Texas added 1.6 million people between 20 and 23. And as Bob said in his talk, you know, about 70% are in these 4 major markets. And are you seeing around the country, and you operate, you know, nationally and internationally, you know, any other place with this major type of density, spending power, and growth, is there a comparable place? Because, you know, Texas is at the top on everybody's investment list today. I'm just interested in your opinion. And, you know, with the market that's been curtailed from standpoint of higher interest rates and higher costs, there's been much less development. I mean, we used to build 7 to 9 million feet in this market, and now it's 500 to 1 million. And I think that that's causing, what we're seeing is increased rates because the densification continues. And these people are densifying, and they're buying more at these stores, but there's not that many more stores.
Totally agree.
You agree with that?
First of all, Texas is in a league of its own. Like, Elaine was just at one of our other conferences the other day. Like, it is phenomenal what Texas has been pulled off. And frankly, I think a lot of it has to do with business-friendly, open environment, taxes, all these things add up for an environment that is very conducive. And I think what COVID opened people's eyes onto in the United States is that internal migration is possible. I think historically people stayed in their state, and, you know, the family lives there, and there's sort of this notion of living somewhere else, and like, well, I don't really know, like, is the job I have really somewhere else? I think COVID changed that mentality. I did an event with JP Morgan Chase in Austin 9 months ago for 25 of the top clients in Austin, and it was fascinating because we had a dinner. Of the 25 people around the table, 5 were actually originally from Austin since birth. Mm-hmm. The other 20 had migrated in. Mm-hmm. And that's true across Texas. That is unique to Texas, and is kudos to I think a lot around the business environment and the taxes around Texas. But I agree with you. The fascinating part is, so we're actively building apartments and multifamilies across all of in Austin, in San Antonio, and a number of other places across Texas. I don't see us building any retail in those places. So you got 1.5 million people that moved here, and some are moving to existing stock, and some are moving into these, you know, everything looks beautiful nowadays, and like nice wood buildings. But they have nowhere to shop because no one is building anything next to them. So and that's because this notion of retail, don't invest in retail, don't invest in retail, I think is going to keep this dynamic alive for quite some time, because you would normally think, we did some math that showed that overall retail purchasing across the areas that we have presences in Texas was up 5% last year. What we found was that the actual space per capita of retail in the places where we built our multifamilies was actually down 3%. So in other words, more buying, less space per capita. So that's going to have to catch up. And part of that is construction's expensive. And as long as construction's expensive, you're not going to see this oversupply. You're going to see like lease rates keep rising. Like there's just not enough. That's where I think if you do see a recession, things could change a little bit, because then you could sort of have construction costs come down. You could have sort of longer term people like start coming in and investing. But it is unique to Texas. The migration story is unique to Texas. There's a little bit of it in Florida, but the spending power that's coming to Texas, I think Florida, it's more about retirement. I think Texas, it's more for work. I think it's the working generations.
Well, the investment community got burnt, 86, 90. And they're still that mindset, about it, but they're coming back into the market. However, are there any categories, well, like in, the beginning of the pandemic, there were 120 major national retailers that went bankrupt. And this lately, is Bed Bath & Beyond and Tuesday Morning. Hundreds and hundreds of stores came on the market. They were snapped up. And but it looks like that's over. And it looks like we've gone through the cycle where those companies really didn't adjust fast to online selling. Those two, Bed Bath didn't and Tuesday Morning didn't. They were real late in the game. So are you thinking that there's any more major bankruptcies that, down, I don't know how much retail you have in your $54 billion.
Yeah, we have about 20% of its retail. We think a lot of the washouts taken place. Also, the composition of our retail has changed fundamentally, right? Where we earn the highest per square foot, Apple stores, Tesla stores. It's not Macy's, right? I think that where the income in our retail is coming from has also changed, I think, fairly fundamentally. But there are things that I do worry about longer term. I worry about the fast food chains that are cheap. And I know it sounds weird, but an American doesn't need to buy a $1 burger. They can afford a $12 burger. And so, you put in a lot of $1 burger stores, you're probably going to run into a constraint for the rest of the people in whatever location you've got. It's not popular to say, but the average American has gotten quite a bit wealthier during COVID. That's why Chipotle is doing so well, right? They can afford a $14 burrito. Or $10, $12, whatever. I'm thinking Texas is probably 9, New York it's 14. I'm like trying to add a range here, but I do worry a little bit that there's the longer term losers may end up being, if you look even at Dollar General, they've struggled, and I think part of that is that there is wealth creation taking place. So. We're not living in 1975 where we have to have 2 burgers for a dime. It's okay. People can afford more. So I do worry a little bit about that. And as I think longer term, I know when Herb and I met in New York, I think he was like, this guy's crazy. Because there is another thing that does concern me longer term, in a weird way. Many of you may, or some of you may have heard of GLP-1 drugs. Some of you probably will have heard of Ozempic and Mounjaro, or now Zepbound, and these are the weight loss drugs that are diabetes drugs that people are getting they're either buying over the counter or they're being prescribed. And you may be like, well, how is this connected to real estate? We can look through Chase's anonymized data by individual, right? We bank over 95 million 95 million individuals in this country through Chase. I can identify the people who are on Ozempic through their spending patterns. And why should you care? Their spending on fast food drops about 85%, snacks 80%, like soda 70%. And you're thinking, okay, well, I don't have a soda store. I do have a fast food store. Alcohol down 60, 70%. By the way, there's a shortage of Ozempic, there's a shortage of Mounjaro, there's a shortage of Zepbound, and Eli Lilly just announced that they're going to offer Zepbound, which is their latest. By the way, I don't know who chooses these random names. By the way, they could have just called it weight loss or something. You'll be able to buy it like from a 1-800 number. Like you'll be able to call 1-800. They'll send you connect you over online with a doctor and then just prescribe it to you. By the way, you have to take these drugs forever. Which is not unusual. There's lots of drugs you have to take forever. But you do lose 15 to 20% weight. But it changes your buying behavior and your consumer patterns. Analysts are predicting 5 million people are going to take this. They're totally wrong. Like, it's probably 50, 100 million. Like, across the world, there's probably, it's for technically obese people, but if you're overweight or obese, and like today, if you look at Ozempic sales, a lot of it happens over the counter. It's not, people just buy it. They're paying like $800 a month for it. And people are like, oh, no one's gonna pay that. Sure they do. They pay $800 to drive a Mercedes versus a Hyundai. Like, it's okay. People will do that if they look better, feel better, why wouldn't they? But it's important for all of you to remember that over the next 5 to 10 years, because the spending patterns of that cohort will change dramatically. So 20% of the US population drinks 80% of the alcohol. That 20% is probably a pretty sizable overlap with the people who probably could use this drug. So alcohol sales will probably be struggling. Fast food sales are going to have to morph. So you want to make sure, and I saw that some of the biggest growth areas were the gyms and the green juices. I can't remember which one it was. I'm not really a big green juice guy, but keep that in the back of your minds that like the spending patterns, that who's your target audience? And if the spending patterns of that target audience is very driven towards certain types of foods and alcohol, et cetera, that may really change in the next 5 to 10 years. And when you're charging $1 a burger, it's hard to make that adjustment. You're not making that much money.
No.
So, anyways, most of you are sitting there going, "This is really nothing to do with me." But like, you may want to just think about it. If 10% of this country goes on these drugs, sales of a lot of major companies is going to decline, and it'll decline pretty dramatically. Oh, that's the question. So then what are people going to spend well, first they'll spend it on the drug they have to take. But secondly, I think you're going to see the gym memberships, you're going to see the beauty, and a lot of the services things that are growing are going to continue to grow, right? The spa and massage, okay, for Elaine, clothes. Shoes, Hermes bags, some art, but you are correct. It's going to give them, well, first of all, they'll have to buy new clothes as well. But anyways, I try to think about some of that stuff. Same as, like, for example, I worry a lot about, I think everybody's so excited about multifamily and logistics, which are the two hot spaces. Like, you must own industrial and logistics. I don't know how many logistics buildings you're going to need, but at the end of the day, if you do bricks and mortar right, the part of the logistics is going to be your store. And you're not going to need another one.
Yeah.
And I think that's, and even in logistics, we have a transportation strategy where we invest $5 billion in transportation assets. We've been requested to price up a fleet of, I think it was like 20,000 drones for delivery. So I said, okay, well, that's kind of interesting. So we priced it up. The math wasn't quite there yet. I said, where are they going to land? They're like, well, we're going to pick it up at the warehouse, and blah, blah, blah. And I was like, no, but okay, so you have the warehouse. Have you thought about where the stuff's going to land? So I've asked my team for our industrial properties, how big is the roof space? Because we're going to have, if you have 20,000 drones, by the way, like, the airspace will never be the same, because these things flying around with a roll of toilet paper to deliver to your house, like whatever, like, but this is coming. And so I worry even about, like, logistics. Are your logistics ready for how stuff is going to get delivered in the future? Anyways, so what was the question again?
Well, Walmart just announced a few days ago that they're just about ready to offer drone service to every part of the city of Dallas, DFW. Kind of amazing. I mean, there's no drones. I don't see drones right now, but I don't know what that's going to mean.
Yeah.
Just Walmart alone.
Yeah, I mean,
we've got 120 stores here.
2-hour delivery, if the average package is yay big, like, it's like, why would you send like poor guy in a truck has to drive around the whole neighborhood. Like, it does worry me a little bit. Like, you know, we also looked then in our private equity business to see if we could patent an automatic parachute for drones, because we were also thinking like, well, these drones start falling out of the sky because it's raining or something. Like, we should probably make sure we don't kill anyone. It turns out, by the way, there's 5 companies that already do that, so we were a little late. Anyways, I do think that's gonna, you've got to be thinking about shopping as an experience. It is not a necessity. And by the way, shopping for groceries is also an experience. Whenever my wife buys groceries that get delivered online, I hear a string of complaints for about 15 minutes about the mangoes aren't ripe, that who eats these tomatoes? Like, and she's right, like, you don't choose your stuff. And so there's an experiential aspect to grocery, which is, I think, part of the reason grocery hasn't done as well with home delivery as people thought they would.
Well, you know, when that started with Albertson delivering, you know, I was real concerned. I thought, you know, the retail industry and shopping center business as we know it, we could be a dinosaur, but it didn't work. You know, with the fresh food, they didn't know how to handle it. You know, it was difficult. They hadn't thought it all the way through. But today, I think that, you know, we're seeing the convergence, and Walmart particularly, you know, with the curbside, they really, that's a good answer to somebody coming home from work, and they pull up in the space that's designated, and in 11 seconds, the food is in your car.
Yeah.
And you're on your way.
Yeah.
So let's talk a little bit about suburbanization. It's been a huge movement. We talked about it in New York, and there's been, the retailers have really gotten on the bandwagon. They've followed the people, and the malls have contracted because so many of the tenants that were in the malls now are in the open air centers, and the department stores, which made the mall business, got hurt big time by online sales, and they didn't particularly create great their online presence. I mean, I heard the top guy at Macy's speak in New York, and I thought he was fabulous, but the execution wasn't there. So do you see the continuation of the boom in the suburbs, just like we're experiencing today?
Yeah, I think so. I think there's also another drive that we have to take into account, which is, I don't know how prevalent it is in Texas, but I will tell you in other parts of the country, this sort of buy local, and you know, I don't want to have to drive 45 minutes to get 3 mangoes. I want to be able to go to somewhere 5 minutes away. And as suburbs have continued to grow, and by the way, a lot of multifamily construction isn't happening in town anymore, it's happening in the suburbs as well. And so people don't want to have to drive to do sort of their basic shopping. So I think the grocery anchored stuff is going to continue to do extraordinarily well. Where it's a little trickier, I think, is where you have sort of the higher end strip malls. You just got to make sure that you have some level of diversification, I think, in terms of what services are being offered there. So you can always take a single tenant risk, but then you're just doing a net lease to a single to a company, which I think is a little bit of a different business. But no, I actually think I think sort of this notion of everybody's going to live in town and like everybody wants to be as close as possible. I think that as the Gen Xers are getting wealthier and are moving to the suburbs, they're moving their purchasing to the suburbs, and I think that's what we're beginning to see. And I don't think that's going to stop.
Well, you know, in the open air centers, when we saw the shift of the stores to the power centers, we lost a lot of good stores in the smaller community centers, which has the grocery store. However, what took its place were restaurants and healthcare and services. And these centers have become stronger than ever. It's gone full circle. And now, you know, there's some weakness in the power center category, which was discussed. You know, it's not growing. The cap rates are higher than on other types of location, just because of the risk, you lose a tenant, and you've got a $500,000 hole annually. So, and then it takes a lot of money to put somebody else back in, it's downtime and so forth. So is there any major shift that you see there, or you see it continuing to do well?
I think it's going to continue to, look, COVID changed people's behavior also towards restaurants, right? The whole concept of outdoor patio, like, okay, we had some of that, and COVID hit, everyone's like, oh, I want to sit outside. And it stuck, right? So to your point, even if you looked at some of your properties, you always have sort of this outdoor, I think Bob mentioned it as well, sort of the outdoor patio space, and it becomes more of an experience. It's not a takeout, you're going to stay there and actually stay in a patio. It depends on the weather. So interestingly enough, I think that's a sort of a COVID like aha moment that this is actually quite nice. We should do this more often, and we should keep it. And by the way, we're seeing that trend across the country, and that same trend, as you pointed out, sort of the open air malls, like is also a longer term trend where, again, it's this notion of having an experience when you're actually going to a location. You've got to be able to have those because that's, now that people are settling in and they have money, they want an experience, and that's a little bit different than a drive-through. It's also fascinating to me, and I don't know, I was curious to get your take on this. So we had a picture of IKEA up there earlier, that IKEA is now experimenting with small stores.
Exactly.
Right? And I think it's the same thing. They realize they can't put a big store in the suburb, but they're like, okay, how do I get somebody to actually like still buy something in IKEA? And it shows that the online stuff doesn't quite work. And you're right, like you kind of, well, it's IKEA, it'll all feel the same. But like generally you do want to touch and feel what you're buying, especially if it's something that you're going to be living with. And I think they're realizing that. And that's that same shift to the suburb, I think, is going to continue.
Okay, well, with the densifications going on in Texas, let's just touch a minute on the mixed-use category, where you have either a hotel or an office building or a multifamily unit with the retail. And I think, you said that there was, a actual increase that an apartment builder might get just because of the connectivity of the apartment to the retail and the access to the retail. Can you
Absolutely.
talk just a minute about that?
Yeah. So what we've learned, many parts of the country, Starbucks is key. I know this sounds weird, but like, if I can get Starbucks to be in the bottom of our building in a multifamily mixed use, I can charge an extra $300-400 a month. Which is kind of crazy because it's like they still need to go get the coffee too. It doesn't come with free coffee, but and what you could do is we actually do similar to, I'm sure, what you guys do as well, which is we analyze the spending power and spending data of people who live in our buildings. And we can see how far they migrate to do their spending and what do they spend it on, and then we try to target that retailer to come and sit in our mixed-use building, because then by definition, hopefully we can attract more of the people who tend to pay us higher rents. It's an absolutely critical component. The piece that's been harder is office. The notion of putting office and the mixed use, like, there seems to be, people seem to have a little bit of separation of church and state when it comes to their office and like where they actually sleep. We're trying, but it's not, I don't think that piece of it is quite as successful. We do have the benefit that we spend a lot of time looking at our tenants, where they spend their money. So you can look at a particular zip code by block and then see the spending of people who live on that particular block. And you can see what they spend it on and where they spend it. So for example, in Chicago, it was very obvious that you shouldn't be investing in downtown Chicago. People were living in downtown Chicago and driving to the suburbs to go eat. That was the experience. So, and you generally, what we found is with multifamilies and office, we tend to follow you. Or we tend to follow bars and restaurants. Bars and restaurants usually go to places that are usually pretty gritty, they're a little bit cheaper, and then people are like, oh, it's very great experience. I'm sitting in the shack, and it feels authentic, and $40 steak, but it's in a shack, so it's even better. But what you find is that that's often the precursor for that neighborhood. So we'll follow that will often try to buy properties by following bar and restaurant spending patterns. And to your point, what's been interesting is some of those spending patterns have moved to the suburbs, where people are driving from the city to a suburb for food. And that is like historically would not have happened. And I think that's, again, supportive for this notion that the suburb is really becoming a destination as well.
Yeah, we've actually gone from like 2 to maybe 9 restaurants in this transition of the shopping center, the community center. And they've really become a hub for people and families.
That's right.
To
And
come
we get
to
some of the
those.
highest rents
Yeah.
from people like Italy who'll come in
Yeah.
and they'll have like 15 food experiences.
Yeah.
So you want taco, you can have a taco.
Yeah.
You want sushi, you can have sushi. And like it becomes, yeah, it's part of the experience, I'd say.
I don't see many mixed-use projects being built because I don't know if you're familiar with the Bellevue collection out in Bellevue. A friend of mine owns it, but his grandfather went broke starting it. His father went broke with it. He, finally became of age with Microsoft, moving into the community, and all the millionaires were loaded, and they were able to support the project. Well, I'll never forget what he told me. He said it's the easiest way to lose money 4 ways at one time.
Well, there's definitely components of it that are extraordinarily difficult. And the problem is you now have exposure to multiple sectors simultaneously. And it's hard to be really good at retail and really good at office and really good at multifamily.
Yeah.
Oh, and then we added a data center in the corner because we couldn't rent it out. Like I think it's a different. It might be trying to mix too many things at once. That's why when we do it, I stick to Starbucks. Like I don't really need to try to experiment too much.
Well, you talked we touched on Ozempic, as kind of a mega trend. You monitor all these, whatever's out there you're looking at. Is there anything else that looks like a mega trend that potentially is 3 to 5 years out?
Yeah, so I mean, I look at, the obesity drugs in a weird way, I think is gonna have a pretty big impact on a lot of parts of society. This AI stuff, I don't think is well understood, and most people kind of go, AI.
You said the AI?
AI, artificial intelligence. This stuff is going to change a lot of industries, fundamentally. I actually graduated with a graduate degree in neural networks in AI 25, 30 years ago, 30 years ago. And it didn't change for 25 years. The computers were faster, the data was faster, but what ended up happening about 5 years ago is some smart guys at Google kind of reinvented how artificial intelligence works. And it's terrible at the things you would normally think it would work on. Math. 1 + 1, it'd be like, 1.6, 2.2. It is not math. That's the old AI. That's the stuff I used to do. And that would be like for industrial processes, blah, blah. But turns out this stuff is fantastic for language and vision. And the thing about language is, we're like, oh, yeah, but language is liberal arts, And the mixing of liberal arts with science is something that I think we as a society haven't gotten to terms yet with. And I'll give you an example. People say, well, you can use AI to make up an actor in a movie. I was thinking, well, okay, that's like talking about 101. What's coming is AI is going to write the movie, direct the movie. There's not going to be any people. And by the way, the movie is going to be tailored to you because it'll know that you watch these 24 movies, you like these 3 actors, and you like this kind of plot. So it's going to invent some plot that'll write the movie, and and you won't even know. That's what's coming. By the way, lawyers, you should watch out because, at the end of the day, anything to do with language is going to fundamentally change. This has nothing to do with the past, and it's going to change the future. And I think it's going to be here sooner than people think. And it may have an impact on offices, et cetera. By the way, it's great news for the world because it means productivity will be higher, which means we can all live a better life, et cetera. It's not necessarily a negative thing, but I think that's a huge thing that's not really as appreciated as it probably should be. And those are probably kind of the big ones that I think for me, and life sciences. I know some of you invest in life sciences, real estate, and lab space, et cetera. COVID changed how we develop drugs in this country. It's much faster. approvals are faster. It's becoming much more personalized. Medicine is going to be designed for you as an individual. And I think we're going to see dramatic changes in the next 5 or 10 years in healthcare around that. I am constantly trying to find life science companies to come into our buildings, especially to our office buildings, because I think that's the future. Like, this is not the biotech from 20 years ago. Computing power is now so powerful that you can predict the impact of particular compounds on your body, and I think that's going to speed up drug development. And with an FDA that's been a little bit looser post-COVID, I think we're going to see some dramatic developments in life sciences as well.
Thanks. Well, moving on with, interest, you feel that they're going to follow through with, we got about another 10 minutes. I'm getting the signal over here. So in the shadows, I caught it. So at the interest rate, you think that they'll follow through with some reductions, so there'll be a soft landing. We'll look at inflation through the rearview mirror.
Yeah, but I think that last 3% inflation go down to 2 is going to take a while. By the way, people like soft landing. I think the U.S. could easily grow at 2 or 3% this year. Or you can call that soft landing if you want, but I would just call that normal growth. So I actually don't see any reason why the U.S. won't grow at another 2 or 3%. The wild card is if you get some sort of shock that causes a number of sort of defaults to pick up fairly dramatically. Not so much in banks at this point, because they've really been tested over the last 12, 24 months, but I think more on the corporate side, which again, I think is unlikely, because if the economy grows, you're not going to see that happen. But there is a bubble coming. The bubble in credit is growing, and it's kind of growing in the corner, and it's getting bigger and bigger and bigger, and it's the private credit markets. This is stuff that used to be on banks' balance sheets, then it became private, and you get paid more because it's no longer on the bank's balance sheets. That's a little bubble that's beginning to grow, and it's something I'm watching. I don't think it's this year's problem, I don't think it's next year's problem, but it's coming. And I think it's something to watch out for, but again, it's what it's in the back of my mind I do worry about in the next 3 to 5 years, because a lot of people have given a lot of money out to lend, and I'm not sure they necessarily know what they lent the money, who they lent the money to, and whether they're going to get their money back.
Well, I was going to ask you about that, because credit funds have been established now, and they're putting a lot of money out, and they're taking a lot of the business away from the small banks. So do you see that changing?
No.
Do you think the small banks
are
going to be okay?
It's gonna, look, small banks are always gonna play a role in the local communities, because these private credit managers, those deals are too small, so it doesn't really work. But they're branching, they've raised so much money, they're branching out into lending, including into real estate lending. We've done some of our best borrowing from some, as a holder, as an owner, we've borrowed from these guys. And by the way, they have no idea what they're doing. So like, it's been great, but it does make me really nervous that it's a little bit undisciplined. And I think in the next couple of years that will become a problem.
So we should watch that area.
But it'll indirectly become a problem for the Fed. But I don't think that's this year. Well, I hope it's not this year, but I don't think it's this year. I think that's still a couple of years away.
So are you buying or selling right now, or are you just kind of staying?
I would love to buy. I just have no money. Like I would, no, I mean, I'm talking from a client standpoint. If you look around in real estate in the United States, there's queues from almost all institutional and retail investors to get their money out. And that's why you're seeing kind of it's fascinating. The real estate market is in one of these unique periods where supply is down, income is up, yet prices are down. And there's this sort of notion out there that real estate is a bad place to be. Office is dead. I mean, I don't know how many of you work from an office. I'm assuming it's all of you. And like, look, if I think of London, 2/3 of the people in London died during the plague. And yet people still live in London and have offices in London. Like, this notion that we're all gonna be like living in a basement and like telecommuting on Zoom. The fact that Zoom has forced all their employees back to the office should tell you something. And by the way, the #1 real estate investors in this country, who you all know well, big competitors of mine, who all hate office, all have mandates that their people have to be in the office 100% of the time. Let me tell you, office isn't going away. But that mantra is so loud that it scared people, and they're all still trying to get their money out of the real estate market. And that worries me, because that's like an overhang that's going to be there probably for another year or two. Now, that can reverse really quick. You see a big name go out and take private, a public REIT in office, the whole world will change around real estate. All of a sudden, people will want it again, and all those Qs out will become Qs in. But right now, the technicals for clients wanting to put money in real estate is pretty bad.
So a city like Dallas is growing like crazy, and new companies coming in like crazy, and internal expansion. Offices is a good thing. See, I think that it's a great opportunity right now for an entrepreneur who's renting to go buy their own building.
100%. Like, literally, I was in Japan twice in the last 3 months. Why Japan? Because the Japanese investors are the only ones who don't own any large US office buildings. I went to the Middle East, they're like, well, I have like 12 Park Avenue to 10 of these, 5 of those. I'm kind of long, I don't wait anymore. But the Japanese don't own any. And I've had a lot of conversations with wealthy European families who are also interested, including in Dallas, to buy office. Because they're all thinking like, now what they're finding out is that they come here and they're like, okay, I'm ready for my 40% discount. This is going to be a great deal. Yeah, and there's no one willing to sell it at those prices. So there's still a clearing price that needs to be found, and that's an overhang on real estate. So despite, and we see the exact same, very similar dynamics that Bob described in terms of some of our lowest vacancies ever, the highest per square footage sales we've ever had. Foot traffic is now above pre-COVID levels. The values of most of our assets are down 20 to 25% from pre-COVID levels. And by the way, I don't see much sign of recovery, because until people are willing to deploy more capital back into real estate, this is going to take. So it's more of a mental issue, I think, for a lot of people, and they're already long a lot of real estate. There is one big savior that's coming: retail, individual investors. So non-traded REITs, some of you may have heard of things like B REIT or Starwood REIT. We now have JPM REIT. The average retail individual investor is beginning to get access to buying these types of assets. And you asked sort of about long-term trends in real estate. In the next 5 or 10 years, individual investors are going to determine these prices. It's not going to be an institutional investor anymore.
I see.
They have more money than all institutional investors combined. You saw the tip of the iceberg when Blackstone launched B REIT 4 years ago. They got to 60 billion almost immediately. They misjudged that, retail likes Apple one day and hates it the next. So you do have to be prepared that people will come in and out. And so I think they might have misjudged that somewhat. But longer term, that trend is very real. The marginal buyer in the next 5 or 10 years of all these assets is not going to be probably even my institutional client.
It's going to go back to the private investor.
It's going to be the private investor.
That's good.
Oh yeah, and by the way, that's a great thing, because their economics are usually very different than an institution.
Right.
They usually have more time, more patience, and frankly, they all have opinions on real estate. That's probably everybody in this room.
Some of these don't belong with an institution. They need TLC. They need hands-on, management, which the institution can't do.
Yeah, absolutely. Yeah. And they'll be long-term holders, and that's a new entrant that's coming out of left field, and it's a global entrant. This stuff is growing. These kind of retail investors coming in from Europe to invest in the U.S., from Japan. It's a different investor. They have different return things. They have different criteria. Pictures matter a lot. I've learned that. You need to have nice pictures of your building. And I'll buy it. You just put a bunch of math. They're like, oh, is this a building? It's a different, they want to touch and feel what they're going to buy.
Yeah. Well, I think everybody here probably wants to hear, a little bit about redemptions, where there's been a big run on Blackstone and Starwood. And is that just natural? Because, people are scared. Maybe it was the aftermath of First Republic and Silicon Valley, those banks. Talk a minute about that.
Yeah, I'd say there's two dynamics going on. And by the way, the same queues exist on the institutional side for institutional funds.
Yeah.
So they're mirrored. But they're two very different queues. On the institutional side, the queues are not mandatory. In other words, you can pull anytime you want, and a lot of people are doing it just for the optionality. They kind of want to see. The prices of a lot of things, the average mega fund on the institutional side was down about 10 to 12% last year. The problem with the public vehicles is that most public vehicles are flat. So I expect that these queues are going to continue because most people don't believe that real estate's not down. And so as long as those prices look kind of frothy and somewhat unrealistic, those queues are going to continue. As I would recommend people to do the same. I was like, if you told me this thing was worth, if I thought it was worth 80 cents and I can get out at $1, well, I'll take my $1. You're like, well, it's a queue. Oh, fine, I'll wait till my $1. And the thing that may change this is if rates start falling and real estate finds a floor, it is very possible that eventually it becomes worth $1 again, and that's how the queues get cleared. The problem is that's like a 2 or 3 year event. It's a little bit of it's still a risk to the market, because if you think of BREIT and some of the non-traded REITs, I'm not picking on BREIT per se, but like on the largest non-traded REITs, they have 2 big exposures, multifamily and industrial. And if you look at what they've been selling to satisfy the queues, it's been like the periphery. They're like, oh, we sold a casino, we sold this piece of land, we sold well, guess what? You're running out of things to sell. And so now we're finally beginning to see the shoes beginning to fall on multifamily, on industrial, and I think that shakeout's going to take 6 to 12 months, and it simply means that those asset classes in real estate have done really well, need to correct. They never corrected with rates going up, and they totally should have. And I think retail investors who are invested and sitting in those queues, they totally get that. And so there's a window. I think this is going to keep a bit of a wet blanket on real estate. The other thing that's changed is that there's another alternative. You can buy infrastructure. Infrastructure in the United States was not really investable until about 4 or 5 years ago. And when I talk about infrastructure, I'm talking about like your local water system, your power grid, windmills, your solar plant, whatever. Very stable cash flows, essential for society, and where the income is linked to inflation. I will say that that's institutionally why you see a lot of outflows, is because money is moving from real estate, which usually that was where people got their stable income, and it's moving to infrastructure as that's becoming available to invest in. That wasn't really available 5 to 10 years, so that's a negative for real estate, because those markets are huge, and the infrastructure market needs huge amounts of capital, and that's going to get sucked right out of the real estate allocation, at least institutionally. But we're beginning to see it on retail side too.
Okay. Thank you very much for that information. JP Morgan has this great presence in Texas.
36,000 employees,
It's a love affair.
33?
Elaine, it's a love affair. We love JP Morgan, and JP Morgan loves Texas.
Oh, we've been here for how many predecessor banks were from Texas?
Many, but Texas Commerce Bank was the main one.
Well, they hired you, didn't you? Or they bought it for you?
They bought it for me.
Yeah.
Well, what does your research say about Texas economic trends going forward, looking out 3 to 5 years? You have any comment on that?
Yeah, so if I look through our real estate lens, it's been definitely one of our biggest overweights, and we continue to, it's the migration patterns. People are moving here and spending money here, and the diversification of the industrial base in Texas is making it a much stable, sort of more attractive place to invest with long-term investments, be it infrastructure or real estate, et cetera. Very different than even 20 years ago or 10 years ago, where oil and gas dominated the economy. That is just no longer the case. It's still an important part of the economy. But that diversification is making it a much safer place to invest. And you're going to see a lot more people from the north come through here to invest because they're noticing these migration patterns. I mean, like you said, 1.5 million people moved here. By the way, be prepared. There's probably going to be another 1 million coming. It's not going to stop, right? And I see the aha moment. We have a large operation in Plano, Texas for JP Morgan, and we've moved a lot of people from New York to Plano. And initially people are like, oh, I don't know, I really want to move to Texas. When they move to Texas, they're all like, this place is great. Well, first of all, they get a 12% pay raise. So they didn't do anything, and they're like, this is amazing, right? And we haven't quite figured out that, we just gave them a pay raise. I'm still trying to figure out how that works. But I think as long as those migration patterns continue, which I don't, the wild card longer term, and I don't see this happening any day soon. The only problem with using taxes to attract people is that the people you're attracting to you for taxes, eventually, where they came from, will have to lower their taxes. And so it's not a permanent gift for Texas. It's a gift while the North hasn't quite figured out that 12% tax is pretty painful and will cause people to move. The day they figure that out, you'll start seeing, maybe one day, maybe not in my lifetime, but the one day, it's not permanent. Like, if a governor in New York comes in and says, we're going to lower taxes to 0% to make it business friendly and copy everything Texas does, the million people won't come here anymore. Right? So it's sort of like, take it while you can. By the way, it's going to take forever for the other states to figure that out. Texas has figured it out, and we're investing in very large amounts here. Like, we own also a large number of pipelines in Houston. We own massive infrastructure projects and E&P projects in the South here. But it is something to think about. It's like, it's not those 1.5 million people it's not a God-given right that they're coming here. They're coming here from good policy, and hopefully that continues.
Well, good. Lisa, I've got two quick final questions. Guys, two quick final questions. And, one is, are you looking to increase your private credit allocation for 24 and 25 because you're in the credit business?
Yeah, on the credit.
And I don't know if that's mezz debt or
on the credit side, on the real estate side, yes.
Products.
Yes. We've got about $15 billion in commercial mortgage direct real estate. I'd like to get that probably closer to 20 or 25. It's still cheap. I actually think it's cheaper than most corporate credit out there. And I lend people money because I want to own the building. So, like, I'll give you the money if I like your building, and if you don't pay, well, it's my building. And, like, if I get it at 50 cents on the dollar, it's kind of a good deal. Mezz is a little bit in between. Mezz is like 10 to 12. I expect it to double, but I'm much more interested in being the lender to buildings I really like. And by the way, our strategy is, if I try to buy your building and I lose because I underpay, then I'll turn around to whoever bought the building and say, I'll lend you money to buy it, because I'm still trying to touch the building.
That's a good model. Okay, final blockbuster question here is, what are you most optimistic about for 24, and what worries you the most?
I'm just super optimistic about the U.S. growth patterns and the U.S. economy. This is an incredible country. I think it's part of the reason I became American. I think so many people take it for granted. This country, this land of opportunity, and I think 24 is going to prove again that the U.S. is going to outshine the rest of the world. So I'm super optimistic about the U.S. On the negative side, I do worry a little bit about this private credit bubble. I don't think it's a 24 problem, but it does kind of, in the back of my mind, it's got like echoes a little bit of 08, 09 in a different space, not in the real estate space, but on the corporate side. But I think as long as the U.S. is growing, it hopefully stays as a small little bubble. That's probably the one thing that I kind of watch out for. I also am not a huge believer that inflation goes away. Like, I grew up in Brazil with hyperinflation. My first job was changing the prices on the board in the cafeteria every Monday because inflation was so high that I literally had to change the price every Monday. And so having lived with that, I just think it's really hard to change people's expectations that, like, you don't need a wage increase this year because inflation's gone. It's pay week next week, or year-end pay next week at JP Morgan. We're going to see how well that works. I'm not sure people are going to buy into that. So that inflation genie may be a little stickier than most people want. I don't think it's going to be problematic, but I still think
Gotcha. Well, let's give Anton a very big hand for being with us today. And we want to wish all of you a very prosperous 24. Thank y'all for being here.
Thank you all. Thank you.